Welcome to the Dividend Talk Podcast, episode 251. Dividend investor mistakes we've made and what we have learned. European DJI, it's been 2 weeks. We missed last week. How have you been?
Oh boy, I was really busy. I mean, I was abroad. For the insiders, I was in America, so we had a lot of time zone difference, and that's why we couldn't meet. I had a very busy calendar. You too, and then we want to record on Sunday, but we forgot it was Father's Day, so we said, no, you do need to prioritize with your sons. There's nothing more important than that, and that supersedes in the podcast episode recording. So I hope our listeners understand. It was probably a little bit weird for the people that suddenly there was no episode, but life life takes over from time to time. But it was nice also being in America. It has been a very long time for me that I wasn't there. And I was before then on vacation. So after 4 weeks of mostly sleeping in someone else's bed other than mine, it's about time that I stay a bit home again. So how to say it differently than I'm back.
Yeah, it's glad to have you back. It was a bit strange last week, and we did try our very, very best. I think we rescheduled a few times. One of us had to get up super early, or was going to be really late. And yeah, look, we had scheduled Sunday. My kids decided to bring me out for Father's Day and beat me at golf and whatever else they were playing. So I'm glad it's back. I did miss last week myself, so I'm glad to have you back. Albeit a little bit jet lagged, so we'll get through this today. But next week you'll be fully refreshed, and we're ready to go again.
Exactly. And next week is the next newsletter, or not?
Yes.
Okay. What are you writing about?
About Legrand,
the French one. Oh my God. I'm really looking forward to that because you have this engineering background. So, and you know a lot about electricity as well, I guess. So I'm really looking forward to your insights because I buy a lot of when I need to replace a socket. I go to the Castorama here, right? Castorama is from Kingfisher, I believe, right? The English dividend stock. Yeah. And then I typically buy Legrand or Schneider materials. So, I also know you did a deep dive on Schneider once. So I'm very interested if it even compares with each other. So if these are the similar businesses or not. So
I won't ruin it now. But what I will say is, when back in my electrician days, there was two brands that I would buy.
Mm-hmm.
MK was one, and Legrand was the second one. They were the two. Yeah. So super interesting to do the deep dive on this. I'm just about finished reading on their history and their overview and so on. So it's time to get into the good stuff and how they make money. But hey, look, that's for next week. Let's have a look at the news this week, and it's hard to get away from what's happening over in the Middle East. There's lots of stuff going on, but we know with Iran and Israel kind of at loggerheads, the oil price, it's affecting the oil price. And what are your thoughts on this? Is it presenting us with a good opportunity to get into oil again, or is it something to stay away from?
What I just find interesting is that we haven't seen an oil price at 75 since April this year. Remember that there was this stock market crash because Trump had some ideas about tariffs. So it's now back again like nothing happened. It's a 75, actually on a near the 2 years high it is now, yeah? So what is really good to see here is that the cash is coming in a shell again. It's just very pity that the war needs to be the leading cause for this. But what I want to say with this is many people are looking at, okay, how to hedge myself in case of a war, how to, what's going on in Ukraine and such. And it's clear that if in the Middle East something happens, oil price is a good hedge, and therefore your oil companies potentially as well. And that's the interesting thing, I think, that I would like people to be aware of, that, this just makes a good hedge. And for us, it means now that you can expect Q2 relatively poor cash flows compared to all the quarters before for the big oil companies, but expect running into Q3 with this oil price to be back on track with also all the share buybacks and everything and the debt levels. So it's very cruel, of course. We don't discuss politics here in the podcast, so it makes no sense for us really to talk about Israel and Iran in itself. But yeah, it just shows you that if you want to hedge your portfolio to these kinds of events, at least having some oil in your portfolio or oil stocks may be a good idea.
Yeah, yeah. They didn't give us much time to take advantage of the low oil price. I think it was around $60 since April. And now it's due to jump back up. So you had a 2-month period, and it probably didn't move the needle too much on
Yeah.
some of our stocks.
But
Probably needed.
did you buy something during that time in oil and gas stocks?
No,
No,
I didn't.
So I bought a few Chevron shares.
Yeah. Total Energies is one. Ever since you've done a deep dive on BP and you have that comparison table, Total Energies is one that's definitely on my mind, but I didn't take advantage yet.
Yeah, because around 60, we usually say around $50, right? Then it's really interesting because that's when some of the companies are hardly profitable.
Yeah.
So those are the nice days.
And you need it for about 3 months, so they release their numbers with that poor cash flow. Their share price takes a little dip, and then that's when you can buy.
Exactly.
We were nearly there. Hey, how about on a European perspective? Google lost its case in the European Court of Justice because it upholds what was it, 4.1 billion suggested fine?
Yes.
What was the case that
it was all around Android? Remember this Android application system in the App Store from 2018 that it was kind of washing out its competition and preferring itself. So yeah, this is very interesting. So Google is, this is advice, right? To find them with 4.1 billion. It's still like up to a European clerk to, make the final decision here. What I find very interesting here is like Trump is not liking the digital tax. They think that we are also just fining tech companies as a kind of a tax as well as a tariff, which is not the case. Also in America, there's like they don't like monopolies, they don't like antitrust. So I think it's very politicized in this whole discussion. But it's very simple. If you break the law, I don't see that the law is favorable towards European companies. In this case, there are not a lot of European companies here, but the law is the law, right? From that point of view. And yeah, I think it's just a price that Google pays for being monopolistic, and the same is to Apple. I think it's kind of all these fines. It's not just Europe. They will get them also in America. They have also cases there. So I think you need to, when you look at the cash flow of, I don't know, let's say 60, 70 billion per year, I think you just need to deduct 4 or 5 billion each year for fines as a cost of business.
All they have to do is register a head office in Ireland, and they'll probably save that in tax. Anyway.
Exactly. But that's also interesting discussion, right? Because that's why they have this digital tax on revenue, because if you don't pay tax, but you do make use of all the infrastructure here, the roads, everything needs to be paid. I do think it's fair to close those loopholes.
Yeah. I mean, big tech has been cracked down on in Europe and America. There's no escaping.
America comes a little bit from a different angle than Europe. Yes, Europe creates a lot of red tape, which makes it hard to do business here. And there's a reason why there's a lack of innovation. And you and I are very much criticizing the EU for this, right? So, but I think when it comes to these kinds of things and antitrust, I think the law is quite clear from that point of view. So,
okay, some dividend announcements. I have two. Target, which we both own.
Target.
Oh, is that how they say it?
If you wanna be a bit snobbish, you say Target.
Target. Yeah. So they announced a dividend of $1.14, which is only a 1.8% increase from its previous dividend. And Caterpillar hikes its dividend for the 32nd consecutive year with a nice 7.1%.
So when I was in the States, I took an Uber to a Target nearby. I spent there an hour just looking around, having lots of fun. I mean, the size of the packages of toilet paper.
That's crazy.
It's so funny. And I saw other funny stuff there as well. Dove, I think it's Unilever, is behind
Yep.
glasses. You need to get a key to open it. So this weird stuff for for the stealing
Why?
and everything. So
Is that a luxury item?
that's what I was thinking as well. Yeah, is that the luxury item? And these are big bottles, right? These are American size, not European size.
Yeah.
So yeah, it's not like you can just walk. Well, maybe they just do it because I think sometimes we see those videos here in Europe, right, where people just walk out of it and during clear daylight and everything visible. So maybe that's it. But if I would go to a Target, Dove would be the last thing that I would steal. I would probably go for a Nintendo Switch or something like that. Yeah.
A bit strange, yeah. But
Yeah.
I mean, these shopping centers are these malls, as they call them, are humongous
Yeah.
over there.
Yeah.
I was in a couple of Targets in Rochester. It would take you 2 hours just to walk
Yeah.
around the whole shop.
Yeah. I spent an hour. I didn't buy anything, but it was just stock safari, and I did this a lot. So Target, yeah, I was just checking, and I think they're still fine. They're still fine. So, but I understand the 1.8 increase because they had bad earnings. Yeah, earnings. I said, yeah, earnings dropped by 15%. I think the last earnings report. So
Yeah,
that they are feeling the weaker consumer. Nevertheless, I think this allows them to have a very good payout ratio. And well, where you first had to buy that, I don't know, at 3% or 2.75% yield, now you have a 4 point something percent yield. So if you're accumulating, it doesn't really matter this 1.8% increase. The dividend safety is very strong here.
yeah, yeah. Nice. So this week we are keeping the topic nice and light and reflecting on some of our dividend investing mistakes. And we last did an episode on this all the way back in episode 8.
Yeah.
So that's a long, long time ago, nearly 5 years ago now. So I'm pretty sure we've made some more mistakes along the way. So I thought it'd be nice to maybe talk about these and see what we can learn from each other and hopefully what we can do better going forward. So let's start with you. Let's talk about some of your mistakes. You're the more seasoned investor here. What have you been doing wrong?
Well, quite a lot, right? One of the things I think, because it was interesting to reflect on this, right? And maybe if I would think an hour longer, I would at some points here. But one of the things that came straight away to my mind was holding on too long to stocks.
Yeah,
Sometimes you see that your stock goes down by 50% and you're kind of price anchored. Yeah, so you want the stock to recover, but you don't really realize that the business is fundamentally broken.
yeah,
Yeah, and that's sometimes hard to see, hard to spot. I do believe that I got better in it over time. Nevertheless, this anchor bias is so strong, and I think many people will resonate with it, with us. If we buy something for $50, it drops to $30, and we lost confidence that we want to hold on again until it's $50. But then, I knew it from theory, but I think it is true. This is an opportunity cost. When it goes to $30, you can sell the money. In this case, I can also tax harvest the $20 and offset maybe some gains that I would have, and yeah, have a stock that is more in a good shape, presents a much better opportunity at that moment in time. So the opportunity costs are just high. So, but price anchoring is really, really a strong psychology on me.
yeah. That you've had mixed results with that, though. I have to say, I know you mentioned Bayer here as your mistake, but there's two companies that come to mind in Unilever and also ExxonMobil. And I remember in both companies you were tinkering around whether you should sell, and in both cases, I think you end up holding on for whatever reason, even though you lost, say, confidence in Unilever, and they've rebounded now and they've started
Yeah,
to,
yeah. No, I was doubting about Unilever, and I wanted to see
yeah,
the earnings, and just at the moment that I was thinking, like, okay, this will be bad. They started to they
yeah,
started
yeah,
to come in with the new CEO, better earnings. So it was like, I mean, it was one quarter away from throwing in the towel. Yeah.
yeah,
So, but I was just doubting a lot on Unilever and ExxonMobil. I was doubting also very much. I even had it on my sell list at a certain moment in time, but I still don't have the strong conviction as I have for Shell. I mean, ExxonMobil will not cut the dividend. Don't get me wrong, but I just don't see the company investing in anything. So I sometimes had a feeling like my money is better off in Chevron or Total Energies or Shell than in ExxonMobil. And I think you see it, over the year, ExxonMobil did nothing. Of course, if you bought at $35 during the oil crisis, but generally speaking, the yield is hardly growing. The price is not going anywhere. So, yeah.
Yeah. I think at one time you were tempted to sell call options on them to try and maybe get some more out of it.
I did that, and I earned a lot of money with that.
And you earned a premium, and you also got the company going back up to, I think it was $100 or something.
Yeah, so I've been typically selling call options on 120 when they were around $5, the option premiums. Yeah.
But I think the difference then between Bayer and those two was Bayer actually had negative news the whole time.
Exactly. And these two companies not. They just had weakening earnings, but they didn't have crashing earnings. And I got dividends, right? Remember?
Yes, 100%. But I always feel like one of my mistakes is quite the opposite of holding stocks too long and selling when I think, and I'm using like my fingers to do the bunny ears, we call them, but selling when I think the price is too high. And two companies really stick out for me in this. And one of them was Microsoft.
Yeah.
And then the second one is ADP. And ADP was probably the first one I did it with. It was at like 100, and I think I bought them at like $80 or $90. They got to 130. I was like, no way they're going to go past that. They're now sitting at 200 and something, and Microsoft has well over double since that as well. And it's something that I've definitely learned is to, if a company share price is high, it's probably high for a reason. And if you look at Microsoft, they were firing on all cylinders. I mean, everything was growing, every segment was growing. Cloud. They buy GitHub, they buy LinkedIn. Everything they did was turn into gold. So I don't know what in my mind told me that it's trading too high. I just looked probably at the PE ratio or whatever botch job of a cash flow. I did discount the cash flow, but I think it's one of my biggest learning is to not sell and actually try and sell less. Quite the opposite. We have two opposites.
But I'm talking. So I do. These were mistakes, right? Holding on to stocks too long, and I'm thinking they may come back up again because with Bayern it was a dividend cut. I should have sold after the dividend cut at the time, but I still thought like, well, this so. I fell into the value trap there. Yeah. Also thinking like, it doesn't really matter because I will use it for tax harvesting when to offset some gains. But then it went another time down. Yeah, which I thought it wouldn't. So I thought I had time to tax harvest. But now I have more the rule like dividend cut is out. I had already for some time, and then dividend cut is out.
But the issue I have with Bayer is that if you take Monsanto out of it, take that out of the equation, you have a really good business.
Exactly.
And it's easily worth €100 a share, easily. But you got this. This company it's Achilles heel, just dragging it down and dragging the whole business. So I could see why you'd hold on to it, because I remember at the time I didn't have them. I was thinking about buying them. I never did. Again, it was all about the value, but I had 2 or 3 investors, and one in particular who was very gung-ho in terms of their value. They're a great company. Look at the other parts of the business. And I agree with him 100%. That's correct. But it was just that lawsuit of Monsanto that stopped me from getting into them. But I mean, leaving that aside, it does look like a good business outside of that. So I can see your dilemma and why you didn't sell, but I think it is a good learning that if you come up against a lawsuit or something like that, it's probably a good time to jump ship.
Yeah, and that was also one of my learnings or my mistakes, is not selling straight after two big problems like scandals, fraud, Monsanto. Yeah. I did sell always after fraud, but I did better, right? So with 3M, with PFAS, I was on time with selling. I purchased NN Group for it. NN Group did really well on me. So it was just a very good decision. So, but we're talking here about mistakes. Yeah. But that's at least what I learned from it with these kinds of situations. Don't wait for too long. And you can kind of assess what the issue is. Yeah, so PFAS we knew it would be years of litigation. Well, NN Group, I went into it knowing that they had these usury cases in court, but I did just a an analysis, I thought like, okay, worst case scenario, it will be, let's say 2-3 billion. It was 800 million in the end, and they could cover the 2-3 billion as well without problems. So for me, therefore, there was limited downside risk, but the company and the shares were priced as if the world would be going down. Yeah.
Yeah. Yeah. Do you find, because I know you bought an N Group and you did a deep dive in them with the newsletter, but do you find since starting the newsletter that you are forced to dig deeper into companies that you might not have dug as deep in the past? You might
No,
skim the
not
headlines, or
no, not really, because I think you know me. I've been always doing my due diligence, right? So
yeah,
also when I did the YouTube videos or on the blog, you will find also some deep dives.
of course.
Um, it's just a much higher tempo now, yeah, in deep dives. So we have done 37 now, I believe.
Yeah,
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 so
37.
if you would buy all of them, you would have a good portfolio. Although not every deep dive we fall in love with the companies, some not at all, right? So
Yeah,
yeah,
yeah. I find it interesting because one of my learnings is to treat my portfolio more like a bar of soap. Because if I look back over my transactions over the first 5 years, there was a lot of turnover in my portfolio, and I figured that out when I was trying to compare dividend growth year over year. And I noticed, like, I have this little pivot table, and I noticed some companies, like, for the first 2 years, and then having 2 years maybe sold them and bought them back again. There was like far too much turnover, and for me that showed, one, my inexperience at the time, but also a lack of conviction, and possibly not diving deep enough into the companies to say, okay, I'm holding these through thick and thin. I know what the problems are. I know the risks with this company, and I find definitely for the first 5 years there was a lot of turnover. Now that's changing over the last 2.5 years, and it coincides probably, as I said, doing the newsletter. I'm not covering all companies in my
yeah,
portfolio, mind you, in the newsletter, but it is forcing me to dive deeper into companies, and it's made me quicker at knowing what to look for. So I apply that to my own portfolio a lot easier than what I would have done before. But yeah, I think that's one of the biggest things is turnover. And you can kid yourself sometimes and say, oh look, I'm tax harvesting, I'm doing this and I'm doing that. But I
yeah,
mean, if your turnover is very high as a dividend growth investor, where you're investing for the long term, you have to really look at your stock
hmm,
picking and assess and say, okay, where am I going wrong? And I
yeah,
think for me, definitely in the early days, it was probably a sucker for high yielding, or maybe sometimes even trusting management or falling in love with the story, and not really having a high enough conviction. So I think, yeah, for me that's one of my
yeah.
biggest learnings. And something now, if I'm not as quick to sell as what I used to. I need to really understand, if I'm selling, why did I buy the company in the first place? And I think that's a
Hmm.
good learning for me.
Yeah, yeah, it's very interesting, and um, this connect a little bit to a learning of mine is more like not seeing that a business is simply dead. And I
Yes.
always bring up the Tupperware example, but this was the classic value trap for me, and that's it's deep in me that I like a discount. So whether it's also in personal life, yeah. So it's easy sometimes to step into a value trap, and in this case, I guess I knew Tupperware as an iconic brand from when I was a child. Yeah, the Tupperware parties. So I felt like, yeah, who doesn't love a Tupperware party? And now they bring it to Asia, emerging market. They're just 20, 30 years behind. So it's their time now to have it. And, they have billions of people there in Asia. And then you have Ricky Goings. I mean, just the name already is like full of charisma, pitching everything. And, we're going to empower the women in Indonesia. They will be entrepreneurs earning their own money. And, all spoke to my heart. So, but yeah, it was just dead on arrival already. Yeah, so it was just stupid for me, and not seeing it. I didn't lose too much on this
Yeah.
one because the price fluctuated a lot. But yeah, I think it's out of business now, right?
Yeah, I think so.
Yeah,
I think so.
it,
Yeah,
it went to a few cents at least. That's what I mean.
yeah,
I think I
penny
saw.
stock.
I think I sold at $48, and my average price must have been 52 or 54. So it was not too bad, but still, I could really bump my head and think like, Why? Why?
Yeah, but I mean, I had the same learning. I mean, you fall in love with the story behind it, and
Yeah.
I look at Walgreens, and I mean, they were struggling financially, but then you look at the company itself, and you hear these. I mean, we don't live in America, but you hear these stories saying like there's a Walgreens within a mile of like every house in the United States, and they're building this Village MD, which on paper looked really, really good. They were doing lots of acquisitions, and you've kind of fall in love with the story behind it. But actually, you don't really understand what it means or how they're actually going to implement something like that, especially when you don't have a background in. I mean, I'm not in pharmacy or anything like that, so I kind of fell in love with the story. I pat myself in the back really early with Walgreens, and I remember I bought them at, I can't remember, it was 38, and they shot up to like 42 or 50. I was like, yeah, I'm a brilliant investor, but it turned around quite quickly, and also held on to that one a bit too long. I ended up making a loss on them, but yeah, I fell more in love with the story than actually looking at the fundamentals. And what was staring me in the face was like a declining trend in earnings, in revenue, and
Yeah.
margins. So I could have definitely got out of that one a hell of a lot quicker. But it was more an emphasis on future growth
Yeah.
rather than what the numbers are telling me, and that was a big problem for me. So
I saw
yeah, I can.
Walgreens last week, and they are now taken over and privatized, right?
Walgreens?
Yeah. Weren't they privatized?
No, I don't think
No,
so.
they.
Were they?
I thought so. Yeah.
How did I miss that?
I'm not sure. Let me check. Walgreens. No, maybe not. I don't know. No, they're trading at $11. I thought there
Yeah,
was
yeah.
something around that.
It's in the process of being taken private. In March, announced a definitive agreement to be acquired by private equity firm
Hmm.
Sycamore Partners. Oh,
Yeah.
missed that.
Yeah.
I'm not surprised with them trading that low. Of course, they're going to be taken
Yeah.
taken private.
Yeah. 75%. And what point did you sell?
I sold them at around 28, I think.
Oh, okay, so not too bad for you.
Not too bad. No, it wasn't. It could have been a hell of a lot worse.
Yeah.
But like I said, I could have definitely sold them
Yeah.
a lot earlier. A lot earlier.
Well, other mistakes that I made are turnarounds. We spoke about that before, so turnarounds, try to avoid it. I do have now a definition formulated for turnarounds
Yeah.
because you will because it's confusing when the headlines in the news say about a company when the share price goes down, it's straight away they're talking about a turnaround because it's driven by the share price narrative.
Yeah.
So for me, for instance, Texas Instruments is not a turnaround. Texas Instrument is going through an investment cycle. The share price relates, how is it, goes down with that during because there's less cash flow, and some people are just very short-term sighted. But you could also argue that the cash flows of Texas Instruments were actually a little bit artificially high because they were not investing enough for the future. They didn't
Mm.
predict the demand cycle that we're in. But I don't call that a turnaround. I call that an investment cycle. And so a turnaround for me are companies that need to kind of reinvent itself because their business is under threat. So Nike is not necessarily a turnaround for me. They need to fix things in the business, but I don't see that Nike is the same as Intel. They operate also in a different market. Now, someone that expects a 10%, calls a 10% earnings decline as a turnaround, then yeah, then just realize that no company has a staircase in earnings for many, many years. I mean, there are a few, but this hardly ever happens. Yeah. So so the question is then when do you call the turnaround? So my rule is now then when you can clearly see that that they are just getting wiped out of the market and they need to do something fundamentally. Yeah, that they're just very rapidly declining. I don't see that with a company like Nike, neither with Starbucks. They have some fixing to do, but and even the CEO may call the turnaround, but I don't call the turnaround as what Intel was for me at the time.
Yeah, I think I get your point. Yeah. Like the Nikes of this world are kind of like mini turnarounds. They have short-term problems.
Seasonality, but also like they grew really hard, so they come down now a little bit. So it's more
Yeah,
like S curves. Yeah,
yeah.
yeah,
Whereas Intel was a market leader for a long time, and it's losing market share hand over fist,
Yeah.
and no matter what it does, it can't get
Can't
that
catch
market
up
share back.
anymore. Yeah.
Yeah, I get your point. I mean, I think if you look at the evolution of this podcast, there was a time when we were known as the
turnaround guys.
show. Do you know what I mean? We were talking about so many turnarounds, and I don't know how our reputation stood up after these turnarounds, but I mean, it just shows our how we've progressed in our cycle as investors, how we view these types of things, and how you move on from them. And and Intel again was such a strange one, because on paper they were well primed to take advantage of this. We had this Chip Act. We had all this administration wanting to bring all this business back to the United States, and they would obviously be a huge beneficiary of that. But their execution has been awful.
I mean, the CEO was more praying than doing anything else. And when your CEO starts praying, that's for me now a good sign that.
I mean, like when he started, let's cut him some slack. We did think that
I think he was really
the
good.
real deal.
Yeah.
I mean, he came out with some good stuff. He came out with this execution and plan. And we're sitting here, bored of us, going, I mean, I think it has some merit here if he can execute this. And but I think the problem is that he spoke so well about it. We gave him he needs 6 months.
And he had a
then we gave him a
strong
year.
legacy, right?
A good CEO before that at VMware. He was an employee of Intel before, so he had all the hallmarks of succeeding there. But it just never worked out, and in the end, I mean, again, one of my learnings is like you can trust management too much. You can put a lot of trust into what they say, into what you want them to do. I think that's just happened with Patty's execution, and maybe it's just deeper than a CEO. Maybe the problems there are harder than one CEO to fix over the short term.
True.
I mean, every product launch that they've had in the last 10 years has been late.
Exactly.
Do you know what I mean? You can forgive one or two, but every single one of them, I mean, I work in manufacturing, and you notice the pressures we're under. And if you're late, you're getting we're getting hammered day in, day out. So imagine how these guys are. For 10 years, I would just get a new job. I'd go working in a shop and just scan for a living, just go boop, boop. I won't put up with it. But I found this with Enegas too. Trusting management can be your downfall. And I'm never going to forgive them for this. I mean, they said they had a dividend floor. They said it. They wrote it. They kept talking about it. I have a dividend floor. And I know they cut the dividend because they're investing in this hydrogen network. And I get that. I completely understand. But I don't care. They told me they have a dividend floor until 2027 or 2026. And they cut it early. And I say you can trust the words that they say, but you really have to do your own due diligence. And look, if I was to look back at Enegas prior to that, I probably would not have foreseen that they're going to invest so much in hydrogen in that moment. But again, it just falls back on you can't trust everything management says. They're there to make investor relations and all that seem rosy, better than what they are. That's their job. Otherwise, the share price tanks. They have to try and put on that show. They're like a showman half the time. So it's trusting them too much is a learning for me. And I guess if you're listening to me, I'm never going to forgive you for that.
But I see still one more other mistake that you have in there, and it comes back to options. You asked me a few questions earlier about ExxonMobil. So maybe full disclosure, I do a little bit of option trading.
Yeah.
But it's typically like, a few dollars here and there. So it's really not a lot. And it's only on stocks I want to own. And so, for instance, I'm all the time selling options for SCHD to try to get them at Interactive Brokers, but it never really happens. But I'm collecting the option income as an example. And ExxonMobil, when it goes to $110, I tend to sell an option, call option 120, because then I would like to cash out on it. In such case, I maybe deploy it to Chevron. So that's how you need to think about it. But what were you doing with options then? I mean, I know it, but more for the listener.
Yeah, I mean, in theory, when I started out going, okay, I'm only going to buy or sell put options basically on companies that I want to own. So dividend paying stocks is how I started. And that's great and that's fine. And if you do that, absolutely, there's a strategy there, because while you want to own the company anyway, you'll earn extra premium while you're waiting for the price to come down to whatever price you want. And that's absolutely fine. However, there's a little bit of a gambler inside of me, and the companies I want to own are these blue chip dividend growing companies that are not very volatile, which means the premium that you receive is not that high. So you're probably looking at 20 cents, 30 cents per contract. I got a little bit greedy and I started going outside my circle of competence and chasing yield, and it actually worked quite well. I think at one point I was earning more in option income than I was in dividend income, and it was going well. But I mean, it's easy to be an option seller of puts in a bull market. It is so easy. I mean, you could just take a dart, throw it at your screen, whatever stock it lands on, and chances are it's going to rise, and that's absolutely fine. I keep two companies in my portfolio still to this day, and they have a 90% plus loss of capital, and one of them is Wish, and the second one was this. It's after changing its name, but it was like Solo Electronica or something. It's like these 3-wheel cars. Do you ever see Only Fools and Horses? Do you ever see that? If you've never seen that, so all our Irish and English listeners will definitely know this. They have this car in it. It's like a 3-wheel car for like trotters independent, and that's what they were selling. So I own those two companies in my portfolio with like a 90% loss on them. But basically they were high yielding companies. I had flipped them 2 or 3 times. It was working great until it didn't. And I think that's where the problem came for me. Chasing yield. It's similar story to with dividend investing. Once you start chasing yields, you start forgetting maybe the basics or the fundamentals, or everything goes out the window and you're just focusing too much on that monetary value. So yeah, for me, that's where it is. And I think at the moment it's more like an opportunity cost, because I invest monthly. I don't have a huge war chest to be investing thousands in options. So if I tie my money up in options now, I'm probably only earning maybe 20 cent a contract, which would be 20 euro or 30 euro. And actually, if I invest that in N Group, ASR, any number of companies, I'm earning more than that. So yeah, options was a big learning curve for me. I do think there's a place for that for people, but if you're expecting to get rich quick, or if you're going to start chasing yield, then you're going to find out sooner or later that it's going to bite you in the ass, which it did with me. So yeah, very big learning, and I've been very open with that throughout this whole podcast series lifetime. So if you go over our old episodes, you'll definitely get the full story. But yeah, that's my only advice. If you're doing it, do it only on companies you want to own or want to sell, whichever one.
I'm also very curious, really, to what our listeners have to say. Maybe there are some mistakes that they made that we didn't talk about. So, if you're listening, please share it on Facebook, on Twitter, or on Discord, and let us know. I'm very curious, because I think that's the beauty about our community, that we can really learn from each other. Also, the questions that are always asked about. There are sometimes stupid questions, I say always, but as a beginner, there are no stupid questions. Yeah, but once you know it, then they can be stupid. But they don't happen really on our Facebook group, so that's a good thing.
No, in our community, we get you know what, we get lots of good questions. We get challenged quite a bit. I love it, because sometimes it makes you think of something in a different angle. And I mean, I don't claim to be an expert. It's not why I'm here. I'm here sharing my journey, and it's great to connect with so many people. And I mean, what I find fascinating, I was on a business trip last week with my boss, and he was asking a little bit what I do and how I do it a little bit. He was a little bit interested in it. And I was explaining to him that we have such a big community. And I said, it's hard to find, even in all these thousands of people, who, although are all dividend growth investors at heart, who are following the exact same strategy with the exact same companies and so on. There's so many ways to chop and change this. It always fascinates me. And we sometimes do a segment on portfolio where we look at people's portfolios. And I used to love them, because you get some really great ideas from that. So I mean, power out to our community. I think it just makes me a better investor, if I'm honest with you. And speaking of our community, we've got quite a few questions to get through, so let's dive into some of them. And Marcus has asked us the first question, and he said, "I know this subject has been discussed before, but I dare to formulate that this is a little bit different. How do you avoid the Joseph Carlson effect as you learn more and more about investing?"
Yeah, so what he's referring to, that he started as a dividend growth investor, and now is also just a lot on, let's call it, growth investing. Yeah.
Okay.
Although those stocks often also pay a dividend, but the dividend is not the most important anymore. And It's really simple. I find I'm investing for income. I want to have the income, and his investment style. Then you need to do the 4% rule. You would need to sell to let's say have income out of it. So it's not that I mean I will have struggles probably with when knowing when to sell and such. I do find it harder to value such companies that are experiencing a lot of growth. Could I develop myself in it and maybe start mastering it over time? Probably yes. I think that's with a lot of things that you really get deeper knowledge in. But it would be for me just a waste of time because I'm income investing, and I think he was probably not so interested to become financially independent because I think that his YouTube channel got him there already. Yeah,
Yeah,
so his income from YouTube, and if he knows that he will not stop working anyway and he's doing what he loves, then I mean, in his case, he's earning tens of thousands of dollars with what he's doing per month. Yeah, then I would also not worry too much anymore about having an income, right? Specifically in such a case when it's very scalable what he does.
yeah, yeah. I do get the point of the question, though. That I mean, as you learn more and more about
Yeah,
investing, depending on the type of guests you have on and who you're speaking to, your circle of friends or your community, if you're more tailored towards growth investing, constantly in that sphere, talking about those type of companies, you will probably get more and more skill in those types of companies and naturally progress into that. But what I feel I won't go into that is one is the psychology of it. We spoke about that with a couple of guests on the show
yeah,
before. But two, as you said, my goal is income. It's not to build as much wealth in there to have like $1 million portfolio. I don't care if it's $1 million in my
yeah.
or €1 million in my
And for
portfolio.
it, um, a channel focused on growth investing gets more viewers than a channel focused on dividend growth investing. So he had
Yeah,
also there I said, if he knew that he wanted to build out an empire with that, then you should probably not stick to dividend investing alone.
yeah. It's definitely a bigger niche, and it's definitely more interesting in terms of when things are going really well,
Yeah,
you can earn a shit ton of money.
yeah,
I mean, we're sitting here talking about 3, 4, 5, 6% dividend increases. We're not talking about 60, 70% returns in a year. So it's sometimes a little bit different, but yeah, I think it just comes down to your goal and where you are in your life. And I'm more investing for income. I want to replace my current income with my work with dividends to give me the option to
exactly.
retire early if I want, and that's where I feel I would be different than Joseph. No disrespect to Joseph, of course. And yes, Marcus, he said, please get Joseph as a guest on the show. I think we reached out to him before, but hey,
No,
we
no
might try
response.
again.
Yeah.
Yeah, no response. We're not big enough, maybe, but let's see. Let's push again. Drip has asked us, well, asked you more likely. Did your trip over to the United States change your conviction with any of the businesses you own?
No, not so much. Although I did complain on Twitter to Howard Schultz about Starbucks because I did feel a little bit like the human element in the experience is gone, which we still have in Europe, right? So the marker,
Yeah,
they just put a sticker on your cup. Everything is machines. It didn't feel like it used to feel, let's say, 6 years ago. So, and I know they're changing it, but it's not going fast enough in my opinion. I think how much time does it take to say to as a CEO, like, okay, every store that doesn't have long waiting lines where people complain, you just use the marker again, ship markers all around the country and get the stuff back as soon as possible, bring this
yeah.
human touch back. So there's a little bit there that I think they can speed up. This really can be executed within one order through to the whole company.
Yeah. And part of the fun was when they wrote your name wrong.
Yeah, but that's what I mean, and they
So,
can
I
leave it
mean,
to the barista, right? The barista can do
yeah,
it when they are very busy. They use the stickers, but when they are not so busy, just take the time to write a line on it, and probably 60-70% of the time they will be able to write the name on it because it's
yeah,
just rush hour that they are maybe overwhelmed.
yeah. But still as busy as ever over in America, over in the States, I guess.
It's hard to say. I'm not spending the whole day in the Starbucks there, but
Yeah,
when I was there during the day, even the Starbucks was full. People were on their laptops doing stuff, ordering stuff. Yeah. So I can't say that I saw something that really concerns me.
Just a guy asked us about oil, which we spoke about earlier in the show. So I'll leave that one there. And Super Kyle asked us a question on Spotify. And his question is, what is your out, your end game? I know it's to live off dividends. However, as a compulsive saver myself, and the fact that I'm looking to build generational wealth so my kids have income, I feel a conflict when thinking about spending my pot, when all I've done is grow it. How will you both address this and change from saving to spending?
I think it's hard, but I already noticed that I'm keeping my savings rate flat at the moment while my salary has been growing. What I'm trying to say is like I am spending a little bit more here and there just because I can afford it, which I would not do 6, 7 years ago.
Yeah,
So I think I'm slowly getting into that phase. And I've been also thinking about it. I don't think I want to leave. I mean, I will leave the wealth to my kids, but they don't need tons of wealth. Once, I don't know about you, but I would like my kids to understand the value of money. I don't want them to be spoiled. So I prefer to spend much more time on the teaching and then thinking about how much money they will need to get. So I
yeah,
really like what's this book about Babylon, the richest man in Babylon?
yeah,
Yeah, I think I should go down that path. Give my both my kids like a certain amount of money at a certain moment in time, and ask them to grow it. And if so, if they do this in a sustainable way, then they can take over the wealth management of the family at that moment in time. I
yeah,
think that's one of
yeah,
the best ways to teach them because they will notice that it's not easy.
yeah. I guess, in my point of view, I don't. I mean, I want to get to a position where I'm earning, as I said earlier in the show, I want to get to a position where I'm earning what I'm earning in my workplace now,
Yeah,
because I know I can live comfortably and save almost 40%
yeah,
of that. So that's the position I want to get to. But I don't see myself giving up work in some capacity. I
yeah,
will have to do something. So I will still be earning. So
yeah,
I don't think I'll ever be just
yeah,
taking from my dividend
yeah,
part. So that might ease the burden a little bit. Maybe when I'm fully retired and drawing my pension,
yeah.
I need to prop it up with my dividends. But I mean,
Yeah, but do you think
that's
you
what
will
I've.
spend more? Because I really liked what Ron recommended us, the book Die with Zero.
Yeah,
And that really influenced my thinking a little bit. Like, yeah, I don't really indeed need to be the richest guy on the cemetery. So I will probably take it easy at some point in time. So I will at that moment in time probably let my lifestyle inflation go hand in hand with my dividend inflation to some extent
yeah,
because you're still the
yeah, but
portfolio behind the real estate that is paid down then.
yeah,
So for instance, maybe when I'm 65 or 70, who knows, maybe by that time the dividends are that much that I can just fly business class abroad instead of economy class. These are the little
yeah,
things that I wouldn't I will probably just do then.
yeah. I have a little bit of that built in at the moment. Is like I go on a couple of holidays a year, maybe at least two, sometimes three. So I already have that factored into what I earn. So if I can replace that, then I've already have that covered. So I couldn't see myself traveling like some people like 9, 12 months of the year, especially if I have like grandkids and stuff here. But who knows what way that works. But yeah, I just don't see myself giving up work. And in terms of my kids, I don't have a set amount that I'd like to leave them. I do want to leave them something, or more
Yeah,
so maybe their own kids. Because I look at something as simple as buying a house.
yeah,
It was a lot easier for me to buy a house 12, 13 years ago than it is at the moment. I mean, at the moment now you're looking at average price house, it's probably about 8, 9 times your salary. It was 4, 4.5 when I bought a house. So it's a lot more difficult. So of course, if I can help my kids, I'd
yeah.
100% want to leave them something. But
But I'm still curious how that will look like in 20 years from now with this whole gray wave, baby boomers
yeah,
dying by then. Yeah.
yeah.
So there may come a lot of real estate still available over the next decade.
Yeah, of course,
Yeah,
it might change. Who knows? Who knows? But yeah, it's you have to live your life too. Life is
sure.
for living, and you have to live it in the now. Christian has asked us: is there any other podcasts or maybe blogs that you follow that is about stocks? And if not, do you generally listen to other podcasts?
Yeah, so not so much other stocks. I mean, I like to listen to Ian Lopuk from time to time. Not every
Yep.
video, but some of the videos I definitely watch from time to time. Joseph Carlson as well, but usually he's talking about stuff that I've read already. But I'm, outside of investing, right? I like the Diary of a CEO. This guy, I think his name is Steve. He has really really great topics on. Sometimes also about investing,
Yep.
or things that help us as investors. Sometimes I like to listen to Joe Rogan here and there. Then there are two Dutch podcasts that I listen to. One I listen already since as long as I know, it was on Business News Radio always. It's called Burst Talk. Not every week, but it's just light, and I listen a little bit to the Dutch companies that they discuss. But what I'm a big fan of is the Y Files on YouTube. I don't know if you know this one. The Y Files. Yeah, it's all about complot theories, aliens, this kind of stuff. The stuff that doesn't require you to think, because
Yeah.
I have a very busy job where I need my brains all the time, and then with the newsletter, you need your brains all the time. So the Y Files is like popcorn X Files, because I was a big fan of the X Files when I was young.
Remember that, yeah.
Yeah, so the Y Files, I really love it with Hecklefish and everything. Yeah, it's really
Nice.
really amazing. I can recommend it to everyone if you want some light conspiracy stuff about CIA and masking the aliens and everything. Yeah.
Love it, love it. The one I listen to is Money Makers. It's about investment trusts. I really like that. That's pretty much the only one I have time to listen to at the moment. I've started to learn Italian, which is taking up my podcast and blog reading. I want to, because we spend so much time going over there. I go over there. I'm over there 5 times this year already, and I'll be over there another time. So I'm trying to learn another
So
language.
what can you say then with an Italian Irish accent?
Not a whole lot. Not a whole lot.
But give us something. Now we want to know.
Buongiorno.
Yeah, like what was the actor again that said "Buongiorno" with an
Buongiorno.
American
Yeah, yeah.
accent? Well,
It's not about the accent, but how you use your hands.
okay.
Hello. But yeah, so I've tried to learn that a little bit. I started out with Duolingo, which I realize is not great if you want to try and speak it.
Mm-hmm.
So I've tried other. I'm trying other methods now.
Yeah.
Let's see how it goes. Richard has asked us about a cheerful subject. It's about the US estate taxes. And we spoke about this, I can't
Few
remember,
times.
maybe 10, 15 episodes ago. But Richard is only just becoming aware that if you hold more than 60,000 in your US-based investments, that you are liable to pay US estate taxes up to 40% upon your debt. What is your knowledge of this, and have you began planning how to counter this future problem, i.e. farm-based ETFs, family trusts, etc.?
So I can't do a family trust here where I live. I mean, there is something, but it's more like a workaround. Generally speaking, I'm aware of it. I have also checked. So if interactive brokers, yeah, they will freeze your money. But if you take some European brokers, I think you can get away with it. Just give really good instructions to your, inheritance that will get this money. I am not going because of that reason to avoid investing in the US. My portfolio is like 60-40, 55-45. And I will just keep doing it, because the alternative is that I would start investing in weaker companies potentially, which will cost me more than the inheritance tax that my kids would need to pay. But I think I know you have to, but one of the things I think you could do is email your broker and check how they deal with it in such a situation. And I'll bet you that most of the European brokers, you can probably get away with it relatively easy, I think. This is not
Yeah.
legal advice.
Yeah, it's a bit of a gray area.
Yeah.
I tried to do some research on it, and there was a lot of conflicting advice, even from an Irish revenue standpoint. But from what I gather, as an Irish resident, I think there's different treaties with different countries. We are liable for these US taxes,
Yeah.
but like you said, different brokers like the Giro might not enforce it. For example, and Ireland has this tax that we have to pay. It's 25% tax. Okay. on all our investments, and then we can claim that back. Interactive brokers never enforced it before. The Giro don't enforce it. Interactive brokers then moved to Dublin, so they have a head office in Dublin. Now they're forced to enforce that because they're now an Irish company. So if I use that as an example, if you have a company that's based in Europe and not in the US, they will probably follow more the European rules than the US. Now, it's not investment advice, it's not advice, but like you said, it might be a little bit easier to get away with it.
I would just ring up your broker, and if you're really in doubt, check with an accountant or legal advisor.
Yeah, I'll just tell my wife not to declare me as dead and withdraw my money.
No, but within these kinds of things, right? If you have a lot of money involved, don't take your advice from YouTubers or podcast hosts. Go to a professional, a licensed professional, and just pay for it, because it may end up being much cheaper for you.
Yeah, but even at that, I rang our revenue, and it's so hard to get a straight answer. It's so hard to get a straight answer from these guys, and even with the own Irish tax, because interactive brokers are enforcing this tax, and the Giro are not. I'm now what's June? I file my taxes early, so I file my taxes way back in February this year, and I'm still on the phone with them every week, asking me, why is it this much? And like, I'm after sending them every set of accounts, I have to do manual calculations, and it's a nightmare. So yeah, if you can't get it right in Europe, I don't envisage them getting it right when it comes to enforcing US taxes, but who knows? Peter has asked why UNH is a sin stock.
So I look at UNH a bit as a sin stock because of its business practices of often trying. They have very strong incentives in the company, and that's being documented already. You can just check some of the documentaries, that they do everything to try to find a reason not to pay you. And for me, it is like, if someone's sick and you're covered, you should be customer focused and not think that your customers are thieves. And that's the issue that I have with it.
It's I mean, the more money you have, the more healthy you'll be. It's tough for Europeans. I mean, we don't have a similar type of model over here, so it's quite tough.
No, but I have also private insurance here in Poland. You have public healthcare, and then my company also gives me private healthcare. There is no such thing that they're trying to pull me a leg. I know there's a gray area there as well, but I would say it doesn't come ever close to what we're seeing in America.
Yeah, but I think the difference is, especially in Ireland, is that if you have just public health care, you'll still get the treatments you need. It might just take longer.
Exactly. Yeah.
But you're not denied the treatments. You're not denied the treatments. Whereas I don't know, but I don't think that's the case over in the United States. I know I have a friend of mine who went over there for knee surgery, and he got an itemized bill afterwards, quite hefty. Some of it was covered through his Irish insurance, some of it wasn't. But he asked for an extra bag of ice, right? Just an extra bag of ice to help with the swelling while he was in hospital. How much would you say? Give a guess.
I don't know, $5.
$75.
What?
For a bag of ice to put on there. Do you know what I mean? So it was crazy. He was showing me the bill, and it was. I mean, I could not believe it. I could not believe it. Anyway, over to some stock-related questions. Mayak has asked us our thoughts on Essentia. The numbers look really strong. However, the stock is significantly down because of the slowdown in new bookings. But the book-to-bill ratio is still 1-to-1. Now, I had a brief look at their earnings. I didn't go deep into them because I've seen this question. And they've been ahead of their expectations in both earnings and revenues. So they've come in ahead of consensus, which, I mean, look, people make these predictions and they come in ahead of that, great. But the decline in America was kind of expected, particularly with the Trump administration kind of trimming off the fat. And what do you normally trim first? These bloody consultants. So that's what it was kind of expected to be down 6, 7, 8%. So I'm not too concerned there. What was good news, though, and what I saw was that their AI services, which I did a deep dive on them, and this was probably one of my biggest bull cases around Accenture at the moment, and that is showing really strong growth. So to me, that's probably more of a positive than the drop in America. America is probably not the biggest part of the pie anyway, so like I'm not overly concerned there. I'm definitely more happy to see that the AI services are up. So it's one on my watch list. It's still a little bit too high in terms of share price for me. I want it to drop. I won't say to what, but it's quite significant before I get interested in them. But yeah, it's a strong company. I think they've had a pretty decent quarter considering all things considering. So I would be from the headlines, albeit I would be quite happy with what I saw. Sebastian has asked us, from a Formula One point of view, Visa or MasterCard?
Yeah, MasterCard. Although I'm, of course, a Max Verstappen fan, won't lie about that one. I think the McLarens are doing awesome.
Yeah.
So it must be. And I think Visa is for not for Red Bull, but the Racing Bulls, the sister team.
Yeah.
But yeah, McLaren is having a great car this year, and Piastri is amazing. This young guy, oh my god, he's so focused. You can see that this is champion material.
Yeah, yeah. I mean, Lando Norris would have been one of my favorites, but I think Oscar has come in and just, I mean, come in as an underdog, but I think he's clearly the number one driver.
Exactly.
I think he is. Centrino has asked you a question. So in last week, probably 2 weeks ago now, in the listeners' questions, you picked Legal & General as your high-yielding European stock, but not Chesnara. How would you compare them in terms of dividend safety, dividend growth, etc., etc.?
So first of all, I didn't choose Chesnara because Chesnara is just a very kind of a micro cap stock. Hard to grasp as a company. So I prefer to stay away from talking about such companies because they just require more homework from people, not easy to get. That's why Legal & General, I think they have a similar profile in terms of dividend safety and growth. They are just high yielders, trying typically around 9 to 11%, 9 to 10% at the moment. So don't expect a lot of share price appreciation there. And that's it.
Good. DGI Zerdo has asked a question about General Mills, ticker symbol GIS. So this was their first US holding over 9 years ago. They've added some a few times, and all the valuation methods tell them that it's a good time to buy some more at these prices. But he lacks conviction. Can he borrow some?
Well, first of all, I think you just need to know what you own with GIS. And I believe GIS is just canned food, right?
Yeah.
In those tin cans. So I think if there will be a zombie apocalypse, then that's probably the stuff that we want in our basement. Yeah, to eat from. And that's why I did well during COVID here. So that's what you need to know. Don't expect a lot there. I don't think this is food that will quickly be hyped, specifically with the health trends and everything. May do better during a deep economic recession because it's typically the cheaper price point. That's just what you own there. But to help you, 4.2% dividend rate, dividend yield, 52% payout ratio, about 4% for 5-year CAGR. So together you get like an 8% chowder roll. P is around 13. I think it's still a bit too overvalued because this company is generally not really growing. So I hope this helps a little bit with your conviction. It could fit in a portfolio, I would say, but just don't expect a lot from it. I think the dividend is safe enough with a 52% payout ratio and a 4% yield.
Yeah. Could definitely be one of those companies that do well if ever a war broke out, I would say. Humberto has asked, what's your take on Sanofi at the 52-week low? Have they lost a moat or any issue with its pipeline? And is their dividend safe?
I think this is a typical example where price defines sentiment because not a lot changed except for the sentiment or for the price, let's say. Look, simply said, their sales are growing. They have Duxipent, probably one of the best blockbusters together with Regeneron in the entire industry. But they have a quite large dependency on it with 31%, but it's growing like hell, really, really fast still. Patent is still valid till 2031. We're still 6 years out from this. strong balance sheet, solid cash flow, dividends covered. I think they have a 60 or 65% payout ratio. So I don't really see what has changed. And sometimes pharma stocks just go down altogether. I guess Trump not fancying the drug prices is probably more of a reason than the pipeline itself. Yeah, because of course, if Duxipent would be part of this drug pricing topic, let's say coming from Trump administration, yeah, the revenue is at risk, like any other, like Johnson & Johnson and such as well. So I think that's what is happening to the entire pharma industry right now, and that's the risk you need to feel comfortable with.
Yeah. J. Rig Wealth Management has asked the question about ticker symbol MSTY, which I think is one of these yield max high yielding ETFs. So they want to know how the 100% plus dividend is sustainable. So that's the question. And I mean, this kind of ticker, this company or ETF, should I say, is getting quite popular in the world of FinTwit. I haven't been on Twitter much in the last couple of weeks, but I was on it yesterday and I must have seen about 15, 16 posts from different people on this company. So I had a brief look at it and I was like, wow, over 100% payout ratio. How is this possible? I had a brief look at it, and from what I believe, they have this kind of like really aggressive options strategy play. So what they're telling you is that you're getting the income from their option play. But from what I've seen, this is not always true. I think, right, don't quote me on this, but I think what they are doing is diluting their shares. They're also eroding their NAV. So they're paying out their dividends, yes, but it's actually costing you more. So you're losing money from your investment. So your capital that you invest is probably at risk. So I don't think it's sustainable. Honestly, I really don't. It's not
We don't
my
like
cup of
this
tea.
stuff.
It's not my cup of
No.
tea. It's easy to get carried away with the numbers and throw lots of money. And there's a girl on Twitter. I can't remember her name, but I think she bought like 60,000 of this stuff. I mean, fair play. I would not be able to do that and sleep well at night.
But these are high yield traps, right? In the end.
Yeah, and these yield max ETFs are crazy. I mean, there's plenty of them out there.
Yeah.
But I don't think you make money in the long term over them. I don't know. I could be wrong, but too risky for my liking.
True.
But I think if you're asking to uncomplicate the strategy, I think you already know the answer that it's not a good investment for you. So you really have to know what you own here, know the risks, and yeah, for me, the risk outweighs that huge dividend payout. Has asked for our take on Neste.he. So it's NESTE, and they are on the Helsinki Stock Exchange. So they are a biofuels first mover on several biocircular ideas. In recent years, they are capex heavy, and now their margins have been thinner versus one-off years in the past. But overall, it's developing into a European bio third generation fuel provider. So when I seen that, I kind of looked, interesting company. You know my take on renewables and specifically biofuels. I think is quite a good area to be in. But what I looked at first, I noticed that they have changed their dividend policy this year. So they have reduced their dividend and changed it probably because they are now capex heavy. They're struggling a little bit with cash flow. Their cash flow from operations has been negative the last couple of years, which obviously means they have negative free cash flow. And how can they afford to pay their dividends if they don't have free cash flow? So what I've seen is that they're struggling with their profitability. They're now kind of introducing like lots of these cost-cutting measures, and I see CEOs focusing more on cost-cutting measures than growing the company. It just raises red flags to me, particularly when the dividend is not safe and has already been cut. So, yeah, I like the idea of the company, but it's not investable for me at the moment as a long-term dividend growth investor, I would say. Carlos has asked us, what are your thoughts on Ambra at these levels?
Let's say like that. Think about Diageo, Pernod Ricard, and all of these. So clearly the alcohol industry is beaten, very beaten. And So that's where Ambra is as well. I think it's a fine company. Probably the risk reward is kind of in balance here. That's how I look at it. And by the way, Pernod Ricard is doing they're doing a reorganization and cost cutting exercise, and they also fire quite some employees. It was about to happen. I expect the same at Diageo.
Yeah, it's a struggling industry at the moment, isn't it?
Yeah.
It's quite tough. Pedro has asked, any thoughts about Polish company named, now maybe that's a Polish name, Neuka, ticker symbol NEU.
I need to do a little bit deeper into this. So this one I'll pass along to a next time, Derek.
Okay.
Because it's my home base here. So I want to really have a good look at it.
Do it justice. I like it. And Liberty has asked us for a deep dive on Rubis, and I think that might be interesting. So it might be one we take up at some time. French companies are quite popular, I would say. But that's it. That's the end of the show. Thanks a lot to everyone for listening. Apologies again for missing last week. This week, maybe next week, is going to be quite slow for us. I am on vacation soon as well, but we will do our best to keep up the schedule, and we will see you all next week.